Welcome back to Inner Circle Precision. In this video, we are going to talk about A ICT Entry Checklist, which you need to follow when you want to make money out of the market using this method. Right, so basically, in this video, you're going to learn about stop rates, which is the first step for you to see before you take any action. Then market structure shift, which is the second. Then the third, discount and premium zones, where you are going to take action. Then the best PD array for entry, which is the one that I'm going to show you. And then lastly, the entries and the last but not least, which is basically the example of everything that we would have talked about. So basically, this is going to give you the probability or a higher chance for you to make money using this A ICT model. All right, so basically we need to define the model before we talk about anything else so that you'll be able to follow through as I'll be explaining. So I've actually marked these numbers 1, 2, 3, 4. It's basically to simplify what you are going to see. So it's basically a 4-step process that you are going to follow for you to make an entry out of this particular model. So by basically seeing these numbers, we are saying, firstly, we need to determine the bias. And if you do not know or do not understand how to determine bias, you can actually look back at the previous video, which is a video on how to predict the daily bias or how to predict each and every daily candle. So basically, if you have predicted a daily candle, it means you now understand where the market is going to move next. For instance, we are going to the upside, and when we are going to the upside, we want to see a fake low being issued, which is basically an inducement low that has been issued, like in this particular instance. So whenever there is a fake low that has been issued, for us to complete the model or to validate for our entry, we need to see that low being swept, because below that low there will be liquidity lying there. So if we see liquidity sweep under this fake low, we actually say the second stage has been issued. Then we need to see this move to the upside for the third stage, and then the fourth stage where we are going to make an entry. All right, so let's now get deeper in detail with this particular model so that we'll be able to apply it. So the first topic is stop rates. When the market intends to reverse, that is when on points of reversal, it tends to induce or fix the reversal by actually creating a low. So it will then take out that fake low, like in this scenario, so that we actually hunt for stops or raids for stop losses. Usually traders would have put stop losses right here below the low, and those stop losses are the ones that will actually provide us the liquidity. Then this process is what we refer to as a stop rate. So steps to follow to validate the stop rate are: 1, determine daily bias and wait for a fake low or fake high to be issued. Then 2, let that high or low be taken out, liquidity take out, basically hitting stop losses of traders who would have entered early. Then this is the illustration of what we mean. So in this particular case, the chart is coming from this particular point. We are actually in an uptrend, and this has been determined with the daily bias prediction strategy. And then after that, we can see the market went to the downside. Within these actually candles that were choppy, we understand that whenever this happens, it usually induces traders to go long. And in this particular case, there were traders who were actually buying. And below this low is where we say there will be liquidity available. And that liquidity is what we need to raid before we go further. So we can see a stop rate was issued here, which is basically a violation of this law before the market went to the upside. For those who understand or who have watched the previous videos on this channel, you know that if this occurs after this liquidity raid or stop raid, this is an EBP or an engulfing bar play candlestick that was issued, which you can actually enter. But we are actually going to use other methods within this particular video. So if you want to learn more about this EBP, just go to this channel. in the previous videos so that you can actually see. So this was the initial low that was set, and then it was raided. Then the rule of thumb states that this is an M15 snippet, daily bias is bullish, and a fake low inducement has been issued. Stop rate was later issued, as we can see here. Then the second step is to actually now look at microstructure shift. We can see from what we have actually learned, this is bias buy, or the candles were actually going to the upside. Then this is a pullback. Creation of the initial low was issued, and then after that creation of the initial low, we can see a stop raid or hunting of stop losses right below this particular initial low. And then we can see this move to the upside, which was a quick move. So after a stop raid has been done, the next step is a quick move away from that zone. This will result in breaking of the recent high. Like in this case, we had this recent high, which is market structure break. And this is the second step of stop after stop raid has been done. So in this particular instance, we have seen a move running away from that particular point. We haven't entered the market as yet. What we are now going to do is to actually wait for the market to shift away from that stop rate. Then the next is now the discount price. We know that this particular move away from the stop rate is an impulse to the upside, and what we want to do is to participate within the markets if the price is cheaper or if it comes back to a discounted price. How do we do so? We actually use the Fibonacci retracement tool, where we touch this particular point and this particular point at the 50% of that particular Fibonacci retracement tool. That is where we want to determine the impulse, or basically dividing this impulse by 2, so that we have the upper side as the premium and the downside as the discount. So whatever that we want to do, or the PD array that we are going to be implementing, is going to be coming from this particular discounted price. So this is the third step to get the entry point. We have premium, which is the upper part, and discount, the lower part. However, we want to get involved in the markets at cheap discounted prices, which is basically in this particular zone. So this is the price. This is a price below the 50% retracement level of the structure shift. So basically dividing the structure shift by 2 so that we can get 2 parts, which is the premium and this discount. Then this leads us to the final step, which is to enter the market, to get participating. That is where most of traders would like to understand and learn. How do we participate within the markets? So in this particular case, we have this whole picture of everything that I've been talking about since the start of this video. The first thing was actually determining bias. Bias is going to the upside. We want the market to pull back, and within that pullback, we have this initial low. And after that initial low has been issued, we take out that initial low where there is liquidity. We hit stops, and then this is what we call the stop rate. After that, we can see a structure shift to the upside. Then after that, a break of structure was issued. From that break of structure, we want to look for a PD array, which is basically a fair value gap within the discount price. Of course, I understand there are a lot of PD arrays available, but in this particular instance, we are going to be using a fair value gap for the sake of not confusing traders. So in this particular case, you can see there was this particular fair value gap right here, and then the market went to that particular fair value gap. Within this particular zone, you can actually shift to the small time frames, where you are going to look for the same model, leg, break of low, break of structure, and then like this, where you are going to enter. So the final step is to look for a PD array in form of a fair value gap. This should be in the discount zone, that is below 50% of the shift impulse. So 50% of the shift impulse, and we want to participate below that 50%. Within the fair value gap, we may go lower to lower time frames to look for a microstructure, stop raid, and enter. So should be placed below the fair value gap and the take profit at twice what you have risked, which is basically at 2R like that. So let's now have an example before we actually apply this. So before we do so, check out our free educational Telegram channel, which I've left the link in the description box below. Alright, so basically this is an example, a short one, so that this video might not be as long and boring. In this particular case, we can see it's now a clear picture of the whole structure. We can see that we are trending to the upside, and within that trend to the upside, what we want is to see this model being presented. We can see that an initial low was issued, and here we had this liquidity zone whereby traders who saw this particular point had gone long. And then we had this stop rate right to that particular zone, and then a shift to the upside, which is basically the impulse or structure shift that I've been telling you. And then we want to see 50%. We can see that 50% was somewhere at this particular price point, and below that 50%, that is where we want to see a PD array. And in this particular case, it came as a fair value gap as anticipated. Then here we make our entry, and then our take profit at twice what we have risked, stop loss right below the fair value gap, basically like that. So this is an A plus setup, and it all means that it doesn't occur frequently on the charts. A plus setups do not just occur on the charts, but it takes time, and it will require you to be highly patient for you to get them. And when you get them, they will usually work out. On that note, we've come to the end of today's video. Thank you for watching. See you in the next one.